A stock market index like the S&P 500 can also be examined using candlestick charting. A harami forms upon direct contact with 2400 to produce an immediate downswing. Haramis can be a two-candle reversal pattern, however, they can also often lead to indecisive price action, so they will be examined separately from regular two-candle reversal patterns. Dark cloud cover is a two-candle reversal pattern that is generally more directional in comparison. This dark cloud cover that forms on May 15th and 16th could be closer to the theoretical diagrams, with the second candle closing lower towards the halfway point of the first candle. However, this is the same general price action and it leads to a downswing nonetheless. In addition, this appears alongside other reversal candles near the established 2400 resistance level, and the second candle here is actually a single reversal candle on its own, being a hanging man. Furthermore, the next candle strongly closes lower for an immediate downswing. An inverted hammer forms almost immediately, as the 2355 level is the first major relevant support, that is a gap fill from the previous gap up back here, and there is immediate confirmation with the next candle closing above this inverted hammer's high. This inverted hammer also creates a piercing pattern with the large red candle before it. Again, it is not exactly close to the strict theoretical diagrams. The close could be higher, closer to the halfway point of the large red candle, but the same general piercing price action is still there, and it leads to a reversal nonetheless. Once again, there is resistance at these upper ranges, as the upper wick of the current small spinning top is being rejected. However, this is eventually surpassed, and that is partly due to the existing long-term uptrend coupled with the shorter-term context of the strong gaps up in between the row of green candles, which is in the same general price action as a three marching soldiers. So this is a great demonstration where even though there is no volume on the chart, the candles are more than adequate in explaining the break over a major resistance. And similar to previous examples, after the market has reached new highs, it makes a minor pullback in a consolidation move towards the previous resistance, which is now acting as a temporary support, and in this case, it does its job. It's so strong, in fact, there is rejection close to 24,000 without direct contact to eventually lead to another upswing. And here you can notice some kicking patterns for the downswing and upswing, but the overlapping variety where there is no gap between the real bodies of the two candles and instead their real bodied ranges overlap. A few weeks later, it is more of the same as the market continues climbing, except this time the downswings and upswings show great examples of upper and lower wick rejection. Here is an interesting case where there is an inverted hammer alongside a bull hammer, and essentially they can be combined to form one large doji in a directional context. In fact, this is highly directional context, because the real body of the bull hammer actually completely engulfs the body of the inverted hammer, and this can then be called a bullish engulfing pattern that has immediate follow-through as the next candle strongly closes above the high of both these candles. Overall, this leads to a very stable and strong bullish context that continues the longer-term uptrend towards new record highs. A rapid correction begins after the market peaks with a harami, and when the upswing begins, there is also a harami, with this bull hammer having its real body completely contained within the real body of the large red candle before it. Later, a bearish engulfing pattern forms a small but quick downswing due to the next candle immediately closing below its low. The market recovers, but there is natural resistance at the upper 2700s. There is upper wick rejection with these candles, however, they are certainly no bearish stars. In fact, they are more bearish, because together they form a bearish engulfing pattern that is quite unusual. Because both candles are red, normally the first candle is green to continue the uptrend, but since this occurs, the pattern is even more bearish than usual, and when they are combined, they essentially form one huge red candle, which acts as dark cloud cover to this previous green candle. And a downswing does indeed begin, with immediate confirmation as the next candle closes below the low of both the bearish engulfing and the dark cloud cover that forms if both of these are combined to cover the green candle. A descending trend line forms, however this is eventually passed, to continue the longer term uptrend, and naturally on the way back up there is natural resistance around the 2700s. With normal upper wick rejection and even another bearish engulfing pattern. However, the market only pulls back slightly to avoid a massive downtrend and instead continues climbing higher to surpass the 2700s, where it begins a consolidation range. The market establishes higher, however, the presence of successive dojis and haramis slows down the uptrend. This is all normal hesitation as the market climbs to new record highs. A good example again with a dark cloud cover not conforming strictly to the theoretical diagrams. However, the same rejection of higher prices still does take place over the course of two candles, and regardless, the next candles begin to trade and close below the low of this less strict dark cloud cover to produce a more likely downtrend in the future. A large drop does occur, but it is slow to start due to several dojis with lingering indecision in the market, and when there is the rapid downward acceleration, the 2700s do offer support. However, they produce more of a delay rather than a complete upswing, and the market eventually continues lower due to the strength of the continued selling. Natural upper wick rejection as the market is unable to maintain prices above the now resisting upper 2700s in November. They are mostly downswings that border the spectrum between dark cloud cover and bearish engulfing. A very clear bearish engulfing that is further incentive to sell after the more indecisive combination of a bearish star and hanging man. Lower wick rejection, however, they occur within the real-bodied ranges of these preceding large red real-bodied candles to form haramis, and therefore a more indecisive tone in the market, as opposed to single bullish candle patterns that would produce more swift reversals. In the more medium-term context, the market forms a triple bottom range that is eventually confirmed for an upward reversal after this temporary 2940 resistance range is surpassed. Here is an indecisive doji that is engulfed at previous highs. The next candles close under the bearish engulfing, however, they are green. The tone is bearish, but not overwhelmingly bearish. There is still some indecision here. Progress for a possible downtrend is slow due to the hesitation to decline rapidly from the beginning. In hindsight, it is a large drop. However, if attention is too fixated on the short term and strictly with candles alone, the drop may have seemed very slow during these few weeks in particular. A clear bull hammer is immediately confirmed with the next candle closing strongly above its high, and not surprisingly, this is taking place near the previous lower boundary to initiate a very strong uptrend. In effect, this volatile range was merely a resting phase in the continuation of the long-term uptrend. Despite the upper wick rejection from the gravestone doji, thicker bearish star, and hanging man, the market doesn't become overwhelmingly bearish until the current candle fully bearishly engulfs all of them. The current candle gaps down for a likely downtrend developing. In the short term, this is a very indecisive candle due to its balanced real body and wicks. This is especially because the market tends to deliberate after such a rapid fluctuation, particularly for a major index such as the S&P 500. The gap down created a downward overextension in the short term. Although the market remained bearish, it did not develop upon the initial downswing. Then these green candles gapping back up essentially countered the strong bearish engulfing to reach newer highs. A familiar sight with the market struggling to climb higher in the short term, except instead of one bearish engulfing pattern, it is more a series of bearish reversal patterns such as the bearish star and hanging man. And the current candle closing strongly lower with a gap down, creating the general price action of a bearish kicking pattern. It is a strong drop with a minor delay due to the minor support from the 3200s. A large bull hammer quickly halts the drop as it forms at the top of the upper boundary of the past few years, which now offers significant support, and in the process it creates a morning star pattern. The situation was certainly very bullish with a bull hammer in the middle of a morning star at a significant support range. However, this just proves nothing is a guarantee, and the market continued lower. But despite this, there was still a delay to the continuing downtrend due to this significant bullish context in the short term. Later, there are a series of bull hammers and overlapping kicking patterns on the way down towards another significant range. Another strongly bullish context at this major support range that has a morning star with a bull hammer in the middle and the current candle trading above its high. However, there is still indecision and the market is quite slow to begin rising due to the very close proximity of the previous range, which now acts as the first relevant resistance area. These candles reveal the market to be transitioning from a major downtrend to more bullish sentiment. However, a full recovery cannot be declared until the 2940 level is cleared. The market does indeed find opposition with upper wick rejection along with a bearish engulfing downswing. However, this only results in a minor downswing, and the market is able to stay above 2785 to continue higher eventually. This was more of a resting phase for the continuation of the upward recovery.